Well, hello friends. Before I begin this video, a brief word. This video is for the absolute long-term, patient, delivery-based investor in bullion who's been with me, who's been listening to my advice, who's been watching my videos and reading my media columns since the last couple of years at least. We've started this journey when silver was sub 50,000 rupees and gold was less than 1/3 of where it is today, even after the crash. So hold on, and in the absolute near term, there is a possibility of a great deal of distress, especially for leverage traders. I would not even rule out a brief but a very sharp bloodbath. So keep that in mind when you watch this video. Take care and stay in touch.
Hello friends, in this video I want to take up where I left off from in this video dated 3rd of January 2026, wherein I gave you a broad sword, a broad-based plan about what you should be doing in the calendar year 2026, and specifically there was a segment in which I pointed out to you about what you should be doing about bullion. Now, what you've seen on Friday, which is the 30th of January, when gold and silver have shaken people down to the bone with the bone-numbing decline, or a crash as I would call it, you would be wanting to know what to do here onwards. And there are a few aspects to this video which may or may not be palatable to some of my online family, but in the interest of reality, in the interest of the truth, in the interest of fact, do note it in a very mathematical and impersonal manner, and resort to course correction if you have to. In that video on 3rd of January, I very categorically told you that I am very bullish on gold and silver, and I have been for years. You've seen my videos of 2024. To the best of my knowledge, these were the only videos about how to buy physical gold and silver, how to ascertain purity using electronic testing methods, how not to get cheated, how to negotiate the best possible price and repurchase or buyback negotiation so that you avoid paying a very wide bid and offer spread. Now, being bullish on gold does not mean, or silver does not mean, being blind and buying at whatever prices. In that video itself, I told you, even though I'm very bullish on gold and silver for the absolute long term, I am not comfortable buying at these present levels. Now, what were those levels back then? On 3rd of Jan 2026, when I made that video, that was a Saturday, the previous day, which is Friday's closing price, gold was 1,35,761 rupees for 10 grams on the multi-commodity exchange, and silver was 2,36,316 rupees per kilogram on the MCX. In spite of the fact that gold and silver have fallen, have they fallen to below these prices? Hey, no, they're still not fallen below these prices. So you're still not in a loss. All right. So first of all, if you've been following my work, both in my social media accounts, particularly my Telegram channel, wherein I post all my research, all my thoughts and all my views on the market, and I also put in a lot of data there in formats that are not allowed by any other social media platform. So do connect with me there. The link to the Telegram channel and other relevant must-watch videos and articles, etc., are all in the pinned comment below this video and in the description below this video as well. So what I basically told you in my social media post was, I do not favor electronic gold. And there's a lot of thoughts that I want to share with you about electronic gold and why it's not gold or silver for that matter. Why it will always be a poor second choice as far as I'm concerned. Feel free to disagree, and the comment segment is open to you to basically reach out to me. Now, why did I make that video in 2024 and earlier in my capacity as a consultant to an advisory firm wherein I was a consulting editor? Since 2020, I've been making videos about how to buy gold and silver cheap, a certain purity, etc. Why physical? Why not electronic when it is so easy to buy, hold in demat format and no theft or fear of losses, etc., etc. All that I'm going to come to. Why is electronic gold or silver trading at such huge discounts? As far as I'm concerned, 2 quarters ago, your ETFs were trading at maximum of 2, maybe 3% discount to the future or spot. There's a reason to it. Now this is spot. This is the future. Why would the future be higher? At the beginning of the derivative cycle, you have 2 months to play in gold and silver futures without having to take or give delivery. So there is always a cost of carry or premium built into the future unless it's a bear market when there's a discount going. All right. Number two, there is no GST involved in futures. So basically, you just buy and sell. There is gross settlement, which means if you buy at 100, sell at 105, you get $5. No delivery is to be given or taken. Very easy, and therefore traders are willing to pay a premium for this ease, for this convenience. On the other hand, the ETFs or the exchange traded funds used to always trade at a discount. Why? Now the reason being, in spite of the fact that it's all inclusive. First of all, they don't charge you GST extra, but it's all inclusive. It's still trading at a discount for a very simple reason. Not 100% of the corpus of the fund house that is issued to investors as ETF is invested in gold or silver. Before you tell me, hey, this is cheating, it's not. Allow me to finish. The reason why 100% of the fund is not invested in physical gold or silver is because as per the mutual fund charter, some amount of money, maybe 5, maybe 10%, maybe 12%, different funds, different percentages, some amount of money is kept in cash, not for redemption, but for exploitation of opportunities as and when they present themselves. So imagine if the price of gold or silver was to come down, the fund manager feels this very mouth-watering, hey, I can't miss this opportunity. Let me buy. Where's the money? Hey, 10% cash. Okay. Number two, you think as a fund manager, the price is going to come down. How do you profit from it? Because as an ETF, you're a long only ETF. You can only buy and hold. You can't do anything about the holdings that you have. You can't sell them and buy them like a trader. So what do? You can hedge. You can hedge in the futures market or in the options market. But if at all 2008 global financial crisis has taught us anything at all to veteran traders like you and me, it is that no hedge is a perfect hedge. No matter what you do, you can still lose money in hedging. So the market says, okay, this fund has 5% cash component and this fund has 10% cash component. I assume that this fund holding 10% cash component might hedge and lose more money, and this fund holding 5% cash and hedge can lose less money. So I will assign a higher NAV to the less potential loser and a lower relative NAV to the potentially higher loss-making fund. Which is why ETFs were always trading at a discount to futures and spot. But why have they gone to the extent of 10, 12, 15 and even 20% discount to futures and spot? That I'm going to discuss with you. Now, first of all, if you've stuck with me, you're still not in a loss where gold and silver are concerned. The weekly chart on your screen of gold on the COMEX in dollars tells you that there is an inverted hammer. What is an inverted hammer? The price opens at point A, flies up significantly higher at the period high, closes sharply lower. So the open and close is what the candle is formed, the body is. The wick or the shadow is the absolute top or the absolute bottom. So here the body is at the bottom of the range, which makes it look like a hammer but an inverted one. And in the case of gold, the body of this weekly candle is piercing the body of the prior week's candle, and therefore it's a bearish piercing pattern. Now take a look at the similar weekly chart of silver. There is an out and out bearish engulfing pattern. Now what's an engulfing pattern? The bearish candle is completely engulfing or completely overshadowing the prior bullish candle. Now that is a very negative portent by itself on the weekly chart method. We've seen that the price has fallen. There's nothing that we can do about it. What do you do if you're holding physical? And more importantly, what do you do if you've been unfortunate enough and reckless enough? From my point of view, feel free to disagree. From my point of view, I've told you thousands of times, hey, do not get into anything other than physical or delivery based bullion, gold and silver. I call e-bullion or ETF bullion as toy bullion. I've received ample flack from social media about, hey, I'm holding, this is called the ownership bias. I'm holding ETFs, you're running me down. I'm not running you down, I'm running the ETF down. Anything that quotes at a 10, 12, 15 and 20% discount to the underlying asset which it is purported to hold is not exactly the best thing to hold. Now, why is it trading at a discount? Now, here is again something that I have been warning you since many months, both on my social media accounts, in my videos, and in my newspaper columns in Live Mint, and on electronic weekly columns in moneycontrol.com. Now, this is something called margin funded trading. These super aggressive, super modern, young age, adrenaline filled investors who tell me, hey Vijay, ETFs are much better than your physical idea of buying physical gold. Why are you trading at a discount? I'll tell you why. Now, not only have these guys went ahead and bought toy gold and toy silver, but they've used leverage by way of margin funded trading. Now, what is margin funded trading? You buy anything, stock, bullion, anything at all, by paying 30% of the value of that investment, and the remaining 70% of the value is funded by the broker. Why does he do that? Because he charges you interest on that 70%. Now that's a good anything between 12 to 17, maybe even 18% per annum. Now that's good income. It's official, it's legal, it's permitted by the exchange, and as a matter of fact, the data is provided with a one-day lag by the exchange itself. Here is a chart on your screen about where silver and gold prices are in terms of MCX weekly futures and with a lag where the margin funded trading data is. Unfortunately, the NSE, as on today when I'm recording this video on Saturday, one day before the budget, has not given us data for 29th of January 2026. What I'm interested in is the data for 30th January 2026, because that is when the sharp fall has occurred, and we need to see what will happen on Sunday when the markets open, and more importantly on Monday what really happens to these ETF guys. But that's going ahead of the narrative. Let's come back to where I was talking about the margin funded trading. Now here in margin funded trading, your exposure is 30% of the value of investment and 70% is funded by your broker. Hey, what happens if the value of the ETF goes down after you buy gold or silver? Your broker gives you a call, tells you, listen buddy, your share has gone down to 25%. I need 5% more money. Either give it to me by the end of this trading session, or your trade is squared up. So now you fund more money. Okay. Why? Because that's a margin call. Okay. Now, when you buy any asset with leverage, especially in the case of margin funded trading, you are basically taking on two enemies. What are they? Number one is the price. Price goes against you, you lose money, period. Number two, time. Why time? Because whether the price goes against you or not, all it has to do is rise slower than the interest cost. If your interest is 18% per annum, if the price goes up by 15% per annum, you're still out at a loss of 3% per annum, period. Okay, so you've taken on two enemies rather than one. One is something nobody can avoid. The price is your enemy, period. Anybody, whether buying with own money or leverage money, is taking a risk. But at least don't raise your adversaries by one more. Now, what will happen when the markets open on Sunday and particularly on Monday? Now, this is the crux of this video. The price of these ETFs were trading, in the case of silver, 55 rupees per gram discount where Nippon Silver Bees is concerned. It's quite simply the largest AUM, so I always keep quoting the Nippon Bees. And as far as the Nippon Gold Bees are concerned, if my memory serves me right, it was at a discount of 26 to 27,000 rupees for 10 grams. Why was it at such a steep discount? Because people who had leveraged in MTF, their positions were getting squared up because the price was coming down and margin calls were being triggered. These margin calls will get escalated on Sunday and Monday because the price of gold and silver fell late evening on Friday when ETFs had stopped trading in the equity segment on the NSE and the BSE. Possibly when the sell-off occurs, the discount might go up from 50 to 55 rupees on silver ETFs to maybe 60, 70, 80. I don't know. I have no way of knowing. This is Saturday, 31st of Jan. I don't know where the market is going to open on Sunday and Monday. But the discount can go up because there will be more sellers than there are buyers. Number one, you lose money because the discount goes up. Number two, the problem is that the price itself on the MCX and the COMEX on Monday particularly might come down even more, so you will face another crunching problem. A, the price is down. B, the discount has deepened. So this is why the margin funded trading guys are going to create problems, and not just a problem, a headache for the market on the whole. There is a reason why every trader should be on social media. The social media is not really a good place to collect tips from. Tips are not something you and me want. In the month of May this year in 2026, I'll complete 40 years in this market. So to the veteran traders who I'm addressing in this video, you and me are not here to collect tips, but the social media gives you an excellent platform where you know what everybody is saying, talking, doing, making others do. So you basically get a sense of what the sentiments are like. All right. Now, when a couple of months ago, when I used to start putting up these MTF data on some groups that I was on, some guy used to tell me, you're splitting hair for nothing. What is 500 crores borrowing against gold ETFs or 700 crores against silver ETFs? It's nothing. The value of this market is too big. Now, those guys are feeling the crunch because this borrowing is resulted in a crowded exit and the discount on the ETF has gone up. Hey, do you see where I was coming from at that point in time? Now, let me just tell you what is crunching the discounts. Now, where margin funded trading is concerned, in the case of silver, over 5 weeks, it has gone up by 50%. Over 10 weeks, 6%. Why 6%? Remember, silver had come down in price and therefore the ETFs had got a little shunted out. Over 20 weeks, the margin funded borrowing has gone up by 384%, and over 30 weeks, a whopping 489%. In the case of gold, over 5 weeks, 226% rise in margin funded trading. 10 weeks, 284% in margin funded trading. 20 weeks, 1,116%, and 30 weeks, 805% increase. This is the extent of greed that these tech bros have gone out there, the newbie traders have gone out there and bought toy gold and toy silver. Not only have they bought a toy, they've even borrowed money, paid 18% interest on it, and created a huge hole in the market because they are now trading at a discount and possibly this margin funded selling or this margin call selling may even trickle down to equities and other asset classes to make good the defaults and the deficits that will occur by way of crowded exits that might occur. This is why you should not have held ETFs at all. If you're holding physical, I told you you're still in a profit. If you didn't buy any more, when on the video on 3rd of Jan 2026 told you don't buy anymore. Now, that's all in the past. Now the price has fallen. What do we do now? You ask me, Vijay, what going forward? Yeah, I'm coming to that. Why did you buy gold and silver? The reason is we expect historic levels of fiat currency debauchment. I'm not calling it debasement. Debauchery is a far more profane and abusive word as compared to debasement. I'm saying the currency, fiat currency, will get debauched. It will get brutalized. The buying power of fiat currencies worldwide, not just the rupee, worldwide, is going to fall tremendously. You go out there and it's going to be like a slow fuse. You boil a frog in a kettle of water that is simmering and the fire is slowly but surely being stepped up. The guy doesn't realize and then suddenly he's dead. So very slowly but surely you will see currencies getting debased, their buying power come down. You go out there in January, you can buy 2 bottles of a soft drink with a 100 rupee note. In the month of June, maybe 1 big bottle and 1 small one. By December, you will basically be able to buy only 1. That is welcome to inflation and fall in purchasing power of the fiat currency. So as a hedge, as a protection against this currency debauchement, gold and silver would be your hedges. Has the fear of currency debauchement gone away? If the fear has gone away from your mind, by all means book profit in gold and silver. You're still in profit, remember. As on 3rd of Jan 2026, the price was much lower than where it is today. So even if you sell on Monday morning or Sunday when the market opens, you're still in profit. You want to book profits because you think currency will become stronger, all the more power to you. I don't think so. I belong to the camp that thinks that the currency debauchement will continue, maybe even accelerate. So I don't see why for the absolute long term, and by absolute long term, I mean multi-year viewpoint. Why should a long-term investor be selling his gold or silver in physical format? If you want to get out of toy gold and toy silver and get into real gold and real silver, you will be booking a loss because you will be selling at a steep discount. But at least you will be buying the real McCoy stuff, the real stuff. All right. Now the timing of that is something that you will have to take a chance with. Maybe the discount will reduce. Why? Because the fall has been so steep that even the big money has got stuck. Now to lift itself out of this problem, the big money might just pull up the price once and then saddle the stock at the hapless retail trader. Maybe. Or maybe it could take a V-shaped recovery route and then come up and your discount can reduce to maybe 5, 7, 8 or even 3%. That is the time you want to switch from toy to real stuff. Go ahead and do it. But has the long-term reality changed and multi-year, remember? No, it's not. It's not. In spite of the fact that gold and silver have fallen over 20% from their peaks, which makes it a bear market as per the classic Dow theory of technical analysis, the longer term picture hasn't changed. This fall on Friday was because of the sheer greed that exists in today's highly leveraged markets with these techies, with these newbies, with these fresh blood, with these overexcited gung-ho teenagers who've come into the market after the COVID lockdown and have raised volatility to levels that have not been seen before. And of course, in the social media, like I said, you should be on social media. It's really fun. Guys who have nothing to do with anything, no exposure, are giving you advice on doing any and everything in financial markets. Do they have an audience? Yes, they do. Do they have an impact on the prices? Yes, they do. No matter how big or small, they do. So you better listen because it's going to impact the price of your asset that you're going to buy. So everything is your business. Is the social media your business? Yes. Is a guy who doesn't do anything for trading, as far as trading is concerned, but has 3 lakh, 4 lakh, 5 lakh followers on his YouTube channel? Yes. Why not? Monitor it. Because some guys will listen to his advice and do what they have to do and it impact the price. All right. So stick to your game plan. Keep your ears to the ground for the approaching hooves of the horses of the guys who are coming out there. But do your own thing. If you look beyond 2026, 2027, 2028, you're doing just fine. What happened on Friday, even though it was huge, it is the biggest single day fall in silver after 1980 when Hunt brothers were jacking up prices like crazy. Many of you were not even born here at that time. But believe me, on the long-term time frame, on the long-term time price continuum, this will appear to be a serious but not a life-taking period in your time if you are not leveraged, if there is no interest cost that you have to pay, and you're willing to override and basically ride out this period of turbulence. There are far bigger problems coming. In all probability, in 2026, like I've advocated on my Telegram channel, pro-cyclical hysteresis will lead to hyperextensions in prices that you have never experienced before. Some of you have trolled me for using military jargon in trading because I consider trading to be passive warfare. The only thing is, instead of guns and bullets, you use keyboards and mice. All right. So I have been warning my online family for more than a year about what's going to happen in the market in terms of deceptive style of trading by electronic aspects of the market, electronic segment of the market. It's called maskirovka. Maskirovka is military level deception. So trades would be split into smaller bits and pieces and sent down into the order flow basket and then get executed, and before you know it, before you can get an ingress or an egress, the price has moved already. This will happen to you a lot more often in 2026. It's not going to be easy. Unavoidable, get used to the idea. So sit it out. Learn how to basically keep your conviction levels. Follow me more for more such data-based analysis on my Telegram channel. And before I sign off from this video, a reminder to subscribe to my YouTube channel if you haven't already done so. Click on the bell icon to receive instant alerts about fresh videos being put about here. And if you liked what you saw, do share this video with your friends and family so as to help me reach out to a wider and larger audience and help people make knowledge-based decision systems. I thank you for staying with me in this detailed video. Till we meet again in my next, this is Vijay Bhambwani signing off for now. Have a very profitable day ahead. Take care. Bye-bye.